Let's connect with Sandip Sabharwal as well, who is joining in on the show. Sandeep, let's get in your sense first up as to how you've read into the week gone by, the fact that we had a big event, the expiry, the markets clearly climbing the wall of worry and emerging pretty strong in light of even global nervousness. What's in store for us for the coming month?
Yeah, so the markets have held up very well, and surprisingly so, given the turmoil in the global markets. We've seen deep sell-offs in the tech side in the US, some sell-offs in all other emerging markets, which have been weak for the last couple of weeks. Indian markets have held up, but I think given the overall result construct as well as the valuations at this stage, this is a time to be cautious in the markets. I would think that markets need to give up some gains for them to come to levels where fresh money can be put to work.
Okay, fair enough. And how would you read into what's going on within the entire banking space? Because as compared to what the frontliners did, that underperformance has been a little bit evident, although we did have individual movers. What's the outlook on some of the large cap banks?
So large cap banks are facing earnings headwind at least for this year, given the fact that NIMs are slightly under pressure. Credit growth is moderating given that RBI is keeping liquidity tight. So to that extent, most banks are having to converge their credit growth to deposit growth, which itself means at least 2 to 4% lower growth than what were there in the previous year or previous 2 years. On top of that, the the asset quality cycle seems to have peaked out in the sense that I think from here on it can only deteriorate if further improvements are not possible. Most of the large banks are standing at 0.3 to 0.5% net NPAs, and so unless and until banks see improvement in their operating expenses, which some banks have shown, the profit growth for this year at least will be very moderate. And I think that's what is creating some nervousness in the banking space and leading to underperformance of this sector.
Sandeep, I don't know how closely you've been tracking Mankind, but it's a sizable acquisition that they've made of Bharat Serums, 13,630 crore rupees. Although the street is saying that, the deal is unlikely to be EPS accretive before FY28, a long gestation period, but a very material and significant acquisition with the kind of portfolio that Bharat Serum has.
That's true, and I think such large acquisitions at sort of peak valuations will not, in my view, create value for minority shareholders at least for the next 2 years. And we've seen in the past that large company integrations have their own issues. It's not been easy. In the pharma front, we've seen many acquisitions. They've been very tough to integrate. So what the internals are exactly, I'm not sure, but I think in the immediate term, from whatever reports I've read, for the next 3 years at least, it won't be EPS accretive. So if it's not going to be EPS accretive for at least 3 years, then it can't be positive in the near term.
So, Sandeep, given how fabulous the returns on Mankind Pharma already have been, the fact that it's already scaling around that 2140 odd level post its very recent listing, would you say any dips in the stock should be bought into?
Not really, because this acquisition is so huge that it creates cash flow uncertainty in the near term. And then typically post-acquisition integration is a tough ask, especially if you are acquiring a large company. So I think we are in for some muted growth, at least muted returns for some time.
Uh, is IT at that turn where one should say that, okay, I need to start looking at it? There have been initial sparks of trends which indicate that the worst is behind us. And when you have to buy a stock or a sector, you have to buy it just when the turn has started. Has that turn started for IT where now it will outperform the Nifty at least?
So I think IT is in a sort of a J curve where it's at the flat line at the bottom where but that flat line gets extended, so it's more like a L before it converts into a J. I would think that as of now, most companies are looking at 0 to 5% growth. So at 0 to 5% growth for this year and potentially next year also, what kind of price earning ratios we want to give these companies is the question mark. So I think the contrarian trade has played out. Most of these stocks have rallied 20 to 25% over the last few months. And from here on, upside, in my view, looks limited in the context of the fact that we could potentially be seeing some slowdown coming into the US economy going forward as the high interest rates finally start to take a bite. And typically, we've also seen that in the run up to presidential elections, like we saw in the case of Indian elections, decision making stalls for some time. So that could also impact growth as we go into the last quarter of this calendar year.
Sandeep, do you own any PSU stocks?
Not at this stage, no.
Would you buy on a 10% decline?
Not on a 10% decline, maybe a 30% decline.
Okay. Sandeep, could it be this contra bet for a couple of quarters? Don't buy HDFC Bank, don't buy Kotak Mahindra Bank, वो तो सबको पता है. Look at insurance.
That's possible because insurance as a sector overall has disappointed, like you rightly said, because there were sporadic performances, then sell-offs on disappointing results, etc. Last couple of quarters, we've seen improvement coming through in the performance of insurance companies. This quarter results, especially, we've seen most companies do well, and I think that's getting reflected in the stock price movements also. So from being very fancied, very overknown 2 3 years back, now it's a under-owned sector. So I think if the performance continues, then we could see the stocks actually perform. And especially on the general insurance side, actually the performance has been quite good. Like ICICI Lombard is the only listed player there, but they've been doing quite well.
Sandeep, should one revisit some of these brokerage stocks also? Angel One, Motilal Oswal, whatever had to be done on futures and options has already been done, right? I mean, markets were afraid that, okay, this tax, that tax. You pretty much know that the cat is out of the bag. Directionally, yes, you want volumes to come down, but I mean, the tweaking has been done.
Not really. I think the main restrictions have to come from the regulator side. So there have been just some small tax increases which have been announced. I would think that this will lead to a significant dent in the profitability of most of the company who rely largely on brokerage as the income. So I think on the brokerage oriented stocks, we should still be very careful.
Sandeep, gonna let you go. Thank you for joining in and enjoy the lovely weekend.
If you like this video, then like, share and subscribe to ET Now.